Welcome back. I like charts so much. They are objective, they show you trends you can extrapolate, and they are extremely helpful in making comparisons between time periods. Some are easy and some charts are more difficult. Today I will do my best to make you understand everything and use simple explanations for every chart I will show. I will also make you fully understand everything, so I will also show some charts in between that I won't count. And if you understand these 10 charts and maybe even more charts, you will understand the current and coming economic situation much better. So, are you ready? Then let's go. Before I show the charts, why is it important to have an understanding of everything I will show today and much more that I won't cover today? Right? Why do people who do not care about economics need to understand the things I will show today? Because it impacts you. You eat, right? You use energy, right? I assume you're not homeless as well, and therefore you likely want to know what rents and home prices are going to do. Presumably, many of you also invest. Understanding the economy we are in, you might completely adjust your investment thesis and the sectors you are investing in. There's still a lot of optimism out there, so this video might lead you to be a bit more defensive in your investments. Let's start with GDP numbers, since the Q2 GDP growth number was released this Thursday. We knew Q1 GDP was initially minus 1.4%, but got adjusted downwards later to minus 1.6%. Q2 GDP growth rate came out at minus 0.9%, and by the traditional definition, that means we are now technically in a recession. Of course, the central banks and politicians will tell you that they are not really looking at that definition of a recession, right? They're looking at other metrics and other variables. It's kind of like saying, okay, this is a forest because there are a lot of trees in this area. And then your Uncle Ben, who works for the United Nations Food and Agriculture Organization, says, yeah, well, our definition of forest is different. According to our definition, a forest is land spanning more than 0.5 hectares with trees higher than 5 meters and a canopy cover of more than 10%. And yes, this is the real definition. Okay, maybe a bit of a weird comparison, but you get the point. The government, central banks, and also the National Bureau of Economic Research, they have their own subjective definition of a recession, which will only hint red when we are probably already a year into a recession. And if you take a look at their definitions, you can already make the argument that all of their indicators are blinking red, except for maybe the labor market, which is actually the next chart I'm going to show right now. When you look at the unemployment rate, it is still very low. Now, jobless claims have started an uptrend since April of this year, but in general there's still a very tight labor market, right? That's something that Jerome Powell says a lot. Now, a reason of this is, first of all, that the pandemic is still going on and not everyone is able to go back to work. And second, I think it also has to do with people taking multiple jobs to simply pay the bills due to high inflation. Also, a lot of baby boomers are retiring. Although what is interesting now, what you can see, is that older people are going back to the labor market because of high inflation and their pensions and 401ks are losing value due to falling asset markets. A lot of these people are losing money in real terms on their equities and their fixed income because there are a lot of 60-40 allocations to equities and bonds respectively. When you get a yield at the moment of 2.7% every year on your 10-year treasury, but inflation is running at 9% year over year, you're losing a lot of purchasing power every year. And most dividends are also not even close to 9%, meaning a passive income strategy is not working anymore these days. And although many companies are still doing pretty well and have nice balance sheets, especially the larger companies, they are still in a good position. The small businesses, however, right, the core of the economy, these businesses are getting more and more pessimistic as time progresses, and even large businesses, as of recently, are experiencing this turning point in demand. In my opinion, it is only a matter of time before the labor market also rolls over and we get massive layoffs to which the politicians are forced to declare an official recession and not only a technical one. Now, the third chart is the debt to GDP ratio of the US, China, Japan, and also the Eurozone, so that we do not only focus on the US. But to be honest, most stuff that is happening in the US is also happening in these other countries. Now, the reason why I look at debt to GDP and not only at debt is because the debt to GDP ratio tells you much more about whether the debt is manageable and whether the debt will ever be paid off. Now, the debt to GDP chart of these countries just scream inflation, inflation, inflation. And you know why? Because these percentages are unsustainable. According to the World Bank, countries whose debt to GDP ratios exceed 77% for prolonged periods experience significant slowdowns in economic growth. And it makes sense, right? Because you will never balance the budget this way if you have so much debt to service and you keep on spending a lot and you don't receive enough revenue from taxes. I mean, look at Italy as a prime example. Interest rates have gone up with only 0.5%, with the deposit facility rate now being at 0, and countries like Italy and Greece are already flashing warning signs. And this is what I mean, and what I have discussed in my previous video as well. And although Italy will be fine in the short term since their marginal financing cost of their debt was 0.5% only at the end of April of 2022, the ECB will have to do QE for Italy because the debt becomes unsustainable over time. So maybe not now, but maybe in a few years, then the outlook looks different, right? Because they need to sell treasuries at different rates. But wait a second, isn't QE inflationary? Well, inflation is already close to 10%. Well, yes, indeed. And that is why this chart is screaming inflation. Interest rates will not go up a lot from here, because all countries these days have too much debt, and also because we are entering recession. And if interest rates go down again and QE will become the norm again, inflation will explode. Now that we're also talking about inflation, of course we can't have a Simply Economics video without looking at an inflation chart. Inflation for June came out at 9.1% year over year and 1.3% month over month. The last time inflation reached over 9% was in November of 1981. And I have forecasted that this would happen. Almost every video you have heard me say that inflation is going much higher. I do think, however, that inflation could decrease slightly in July due to a drop in energy prices, and perhaps inflation could cool down as well for the rest of the year. But once the printing presses are turned on again and the Fed pivots because of the coming recession, you can expect much higher prices again. And when I make forecasts, I try to look at the long term, and at this point I still see prices going up in the long term. Looking at other places, inflation in Europe is also close to 9%, and in the UK it's actually 9.4% year over year. But as we all know, the true rate of inflation is much higher than that. And actually I just came across this interesting article which states that inflation in the UK is actually 13.8%. Again, the government always understates the true rate of inflation. The main cause for the difference has to do with the government underreporting the true rents. And this is what they state here: the rising cost of privately rented housing is a significant factor in the discrepancy between these two figures. According to the ONS, private rents in the UK grew by 3% in the year to June 2022, while Travelation's more up-to-date figures show growth closer to 10% in the year to 24th of July. And I think many people can agree that housing prices and rents have gone up a lot, and since housing is around 1/3 of the CPI, there's a massive difference in the CPI if we measured housing honestly. And in line with inflation, let's move to the next chart, which is very familiar. It is the assets of the Federal Reserve, and if you're wondering, yes, the ECB has a similar graph for the asset side of the balance sheet. Now, if you're not familiar with this chart, it is basically a chart of how much quantitative easing, or money printing in simple terms, the Federal Reserve has done. Now that inflation is so high, you would think that it has finally become time to significantly decrease the balance sheet and actually remove the liquidity from the economy. But it looks like it's not that easy given the levels we are still at. In my honest opinion, I think they will try to do it, but once they finally see that the economy is in recession, they will start to QE again, which will lead to even more inflation. And now that we're talking about monetary policy, The following chart is the federal funds rate, which has moved up quickly in the last months. The federal funds rate, which is set by the US Central Bank, is the interest rate at which banks borrow and lend to one another overnight. The Fed raised the Fed funds rate on Wednesday with 75 basis points or 0.75% to a range of 2.25% to 2.5% to fight inflation. At least that's what they claim. Jerome Powell stated that we were at a neutral level, and he anticipates additional rate increases totaling a minimum of 1 percentage point by year's end. Well, okay, but inflation is 9%, so how on earth are we neutral at the moment? You see, if you want to tackle inflation, and this is what I've said many times before, if you want to tackle inflation, you need to get the federal funds rate in this scenario, you need to get it above the rate of inflation, right? So you need to put it somewhere around 9% or maybe 10% or maybe 15%, right? And given that the actual rate of inflation is probably much higher than 9%, yeah, probably closer to 15%. So how is 2.25 to 2.5% neutral? Don't ask me. But let's get back to the chart. Also, if you look at this graph, which is not updated yet, by the way, with the latest rate hike, but you can draw a trend line on this chart and you can actually see that every time they try to raise rates, they fail to do so. And if the trend is your friend, you can be pretty sure that interest rates will soon go down again. You have to understand that they are tightening monetary policy while the economy is deteriorating and very likely already into a recession. And especially with the midterms coming up this year, that really is a no-go. Let's now go to a few market-based indicators to see what the market is thinking. Normally, the yield curve is upward sloping like this, right? That's what we all know. A longer maturity means more risk, and therefore the return or the compensation for the risk has to be higher. Now, what the yield curve at the moment is telling us is that it has not only flattened, but it has inverted. So what does that mean? It means the market prices the yield on a 1-year treasury higher than the yield on a 10-year treasury, for example. And inflation fears in the short term and the Fed raising interest rates make short-term yields go up. In the long term, investors are worried about the economy and think that inflation therefore will go down with it. And that's why people are buying long-term bonds like 10-year treasuries as a safe haven. And since there's an inverse relationship between the price of a bond and its yield, the yield has to go down. And that's exactly what we're seeing right now. Now, I think the market is right in predicting a recession and a weak economy. However, I think the market is wrong in thinking that inflation will significantly decrease. In my opinion, yields should be much higher on both the short end and the long end of the curve and not inverted, right? If we know that a recession is coming, but actually inflation will remain high or at least elevated, well, in such a stagflationary environment, long-term yields should not be so low. They should actually also be very high. And this leads me to the following chart, which is the 10-year minus the 2-year chart. A yield curve inversion, or in this case, the spread between the 10-year and the 2-year, has preceded every US recession for the past half century. Now, that is impressive. And that track record is more impressive than the amount of times Jim Cramer from CNBC got it wrong.
No, no, no. Bear Stearns is fine. Don't move your money from Bear. That's just being silly.
Anyways, at the moment, the spread between the 10-year and the 2-year is clearly negative again, showing a strong sign a recession is going to rear its ugly head. One could say that for the EU countries, this inversion is not present. However, in the UK, the inversion is also clearly present. The explanation for this is that the ECB, or the European Central Bank, has been much slower in raising interest rates than the Bank of England and the Fed, which shows again the impact monetary policy has on short-term interest rates in particular. Now, the final market-based chart is the stock market. The stock market has seen a significant decline, as you probably already know, since some of you are crying yourself to sleep every night while watching your stock portfolio go down in value. But the question is, why is the stock market going down? Of course, it has to do with the central banks removing the punch bowl from the party in the form of stopping quantitative easing and raising interest rates. But I think it also has to do with the coming economic recession and the current high inflation that has weakened the consumers and the businesses. investors are pricing in the future financial health and profits, which are going to be significantly lower. I think though that the market is still significantly overvalued at the moment, with a PE ratio for the S&P 500 of 20, and I expect stocks to go much lower in the future, but there's still a lot of optimism in the market. I think that this is only the beginning of the current bear market though. Now the final chart I'm going to show, and this one actually concerns me a lot, especially because, well, we all have parents. Well, maybe not if you're, let's say, 80 or, 60 maybe. But for younger people, right, we all have parents. And that's why I'm really concerned about this. It is about the current pension fund system. We know that a lot of baby boomers are retiring right now because the peak of the baby boom was in 1960. According to this chart, we will see a peak in the next years to come. And why is this a problem? Well, because pension funds need to pay more in the coming years. And because they know more people are retiring and inflation is running hot, they need to take more risk to make higher returns. According to this article by Barron's, pension funds lost 5% in the first quarter of 2022. And according to recent articles, Q2 is looking terrible as well, with funding ratios going down sharply. And this makes sense, right? The economy is rolling over. The stock market and the bond market are crashing at the moment, and the housing market is slowing down. But in my opinion, it really depends on what the central banks are going to do. I believe that they will probably stop raising interest rates at the end of this year, and otherwise in the first quarter of 2023. Now, that might boost asset prices again in the short term, but in the long term, I see major problems occurring for the incomes of many baby boomers. So if you are not scared right now about the future of the economy, then I am quite amazed actually. Well done. There are also other worrying things I haven't mentioned yet, like consumer confidence at all-time lows, the restricted gas and oil supply from Russia and the energy crisis in general, the war with Ukraine, the rising tensions between China and Taiwan, the food crisis, food shortages and riots and farmer protests where I live in the Netherlands. So there are a lot of shocking things going on right now in the world. But for now, I will leave it here. Please let me know in the comment section below what you think about the charts I've showed you and the future of the economy. Have a nice rest of your day, and I will see you in the next video. Bye bye.